Hi, everyone, and thank you for joining us today for the LPL Research Market Outlook 2021. I'm Bill Brancaccio, Certified Financial Planner with Retirement Wealth Partners.
And I'm Byrke Sestock, also a Certified Financial Planner with Retirement Wealth Partners. So let's take a look at what LPL Research sees as the outlook for 2021 powering forward. 2020 was an unusual year of extraordinary challenges. Now, heading into 2021, it's time to restart the engines, but things are going to look different and feel different. 2020 has changed us, the way we do business and the way we connect. In Outlook 2021, powering forward, we'll talk about stocks and bonds, the economy, and the post-election policy environment. But in the background will be new challenges, new opportunities, and new ways of doing things.
So let's start off by talking about policy. So from this perspective, there's two relevant policymakers that we're watching, the Federal Reserve and the US government. Powell has said we are here and the Federal Reserve is not out of ammunition. He has clearly and strongly stated that. He's become an effective speaker and he's been very effective at giving policy changes and information to the markets. From a government perspective, we appear to have a split Congress, which takes the excesses off of both parties being able to push radical agendas. A split Congress has been positive for stocks historically, as the chart shows. Now, we don't know for sure. Obviously, we have the Georgia runoff. There's 50 seats that are Republican, 48 that are Democrat. So if the Republicans win, they'll have control. If the Democrats win, it'll be a split Congress, 50-50, which would give power to the vice president. So we're not even going to make any predictions as far as how that goes, but the bottom line is the stock market likes to know that even if Democrats control the Senate, it's by a very slim margin where not a lot of radical agendas are going to get passed.
Let's move over talking about the economy. From the perspective of the economy, we're looking at a new start. As you may recall, the US economy was improving nicely in early 2020 after a modest slowdown in the fourth quarter of 2019. Then it skidded to an abrupt stop in the face of COVID-19. The pandemic ended the longest economic expansion ever, one that lasted more than 10 years. This recession was caused mainly by the government closing businesses and people staying home in response to COVID-19. Once the economy began to shift into gear again later in 2020, a new economic expansion likely began.
So let's take a look at what these economic expansions have. Right now, we're in the beginning of a new economic expansion. It's only a few months old from March's lows. However, with a record amount of monetary and fiscal stimulus firmly in place, a viable vaccine likely to become available in early 2021, we anticipate we're going to have many more years of growth to come. As the chart shows, the average length of an economic expansion is about 5.3 years. These expansions can last a while. There's a lot of uncertainty out there. Retail sales numbers have been going down a little bit. We don't know what COVID's going to do to the economy right now, but long-term outlook is that we should have some room to run here.
So let's take a look at how the recovery has gone. How do we describe a K-shaped economy? Well, some areas go up and some areas go down. So far, this economic recovery has been characterized by two different types of recovery. A services part of the economy that's been hampered by restrictions, while manufacturing and good productions have moved forward at record speed. That has led to what some are calling a K-shaped recovery. One part pointing higher or improving, while the other part is pointing lower, deteriorating. As is common during recessions and recoveries, part of the economy has been improving quickly while other parts are lagging. COVID-19 impacted service industries may be the last to bounce back. If you view this also in relation to workers, then this recession and subsequent recovery have likely widened the divide between the haves and the have-nots. At the time of us recording this, we have another $600 stimulus package that may be pushed up to $2,000, and we'll see how that impacts this recovery as well.
So let's take a look at what the economic forecast looks like, Byrke. So continued progress in response to COVID-19, including further stimulus, will likely be the key to sustaining this recovery. We expect that some of the accelerated innovation that came along with COVID-19 response will have a long and positive impact. As pandemic subsides, restrictions are lifted, and consumers' daily lives return to something resembling normal, the pace of the recovery should pick up speed. We're expecting this to occur around mid-2021. This should help fuel above average GDP growth for the full year. We forecast a 4 to 4.5% US gross domestic product GDP growth in 2021. Emerging markets may have led the global rebound. If you look at countries such as China, Taiwan, South Korea, and other Asia emerging markets, they're doing really, really well. We believe that international developed economies may be lagging a little bit behind the United States, such as Europe, Japan. At the end of the day, we're forecasting about a 4.5 to 5% global GDP estimate. Inflationary pressures are likely to be limited. The Federal Reserve, or Fed, is expected to keep the rates low. Not concerned about right now, but in the future, inflation may be something to keep an eye on. The Fed has kind of changed stance in terms of how it reacts to inflation. In the past, it's tried to get ahead of inflationary numbers, and now Powell has stated very clearly this will be reactionary in terms of dealing with interest rates and inflation.
So that sets the stage for what many of you are really interested in, which is what's going to happen with stocks. So let's take a look at where we see stocks heading in 2021. Many of us might say that 2020 was one of the most difficult years we've experienced, the worst pandemic in 100 years, a deep recession, a bear market, and then closing out the year with significant election uncertainty. And yet, 2020 has been a good year for stocks. Remember, however, the market is always forward-looking. As bad as 2020 was, stocks are likely looking ahead to better times in 2021.
So let's take a look at what some of those estimates might look like. A strong earnings rebound in 2021 may allow stocks to grow into what some may consider elevated valuations. Cost efficiencies achieved during the pandemic may persist. We see the S&P 500 index fair value target range of 3,850 to 3,900 in 2021, with the potential upside for better than expected vaccine progress. As the threat of COVID-19 diminishes and the economy moves towards fully reopening, we anticipate that corporate America will begin to showcase its much improved earnings potentials. We estimate about $165 earnings per share in 2021. We see the 10-year Treasury yield finishing 2021 in a range of 1.25% to 1.75%, with our bias leaning towards the lower end of the range. At the time of this recording, the S&P 500 is already at 3,700, well above the expected range by most companies stands for 2020, and inching towards 2021's range. We're looking at modest gains in 2021 at this point. The 10-year Treasury yield is just above 94 basis points, or 0.94%, just under the 2020 estimate range. So there's still some room to run, and our fair value estimate for 2021 might even be low.
So the good news is we're at the beginning of a new bull market from the March lows. Historically, the worst economic conditions have been followed by some of the biggest rallies. In 2020, the S&P 500 index was able to fully recover its bear market decline in only 6 months. This usually takes 1 to 2 years, sometimes 3. In fact, for the first time ever, stocks are in a position to produce a gain in a calendar year after being down by more than 30% at any point during that year. That's quite a comeback. After such a strong rally from the March 2020 lows, it would be logical to think that returns going forward may be more muted. In this chart, we look at some of the previous major bear market lows, most recently in March 2009, and see that stocks tended to add gains well after the initial surge. So we're optimistic looking forward, not just into 2021, but years following.
It's good to hear, Byrke. From an earnings perspective, we're poised for a sharp rebound in 2021 and 2022. Corporate earnings fell sharply in 2020 due to lockdown and recession. Despite the lingering effects of COVID-19, 2021, we expect the economic recovery to drive a big rebound in profits. We potentially could see the S&P 500's earnings growth of 25% in 2021, boosted by cost efficiencies that we were able to achieve during this pandemic.
Now let's turn to the bond market. Information's a little less exciting here. The economy may be kicking back into gear, potentially providing a tailwind for stocks, but the story isn't the same for investment grade bonds. An improving economy generally leads to higher interest rates, and when rates go up, bond prices go down, weighing on bonds' total returns. There will still be opportunities for bond investors in 2021, but it may be a year that requires greater patience, lowered expectations, and a more opportunistic approach. Inflationary pressure is likely to be limited, and the Federal Reserve is expected to keep rates low, but economic improvement and even normalizing inflation could put upward pressure on rates. Overall, based on our view of rates in the economy, we expect near flat to low single-digit returns for the Bloomberg Barclays U.S. Aggregate Bond Index in 2021, with some potential for loss. We don't think that's probable, but we do want to share that it is possible.
Thanks, Byrke. So if we take a look at U.S. Treasury yields, this is an important indicator as it pertains to the bond market. The forecasted path for the 10-year Treasury yield provides a baseline for our fixed income views. We're targeting a 10-year Treasury yield range of 1.25% to 1.75% for the year end of 2021, helped by economic recovery and normalization of inflation. As I mentioned earlier, we're only at about 94 basis points, or 0.94% right now on the 10-year Treasury. From a historical perspective, a large decline in the 10-year Treasury yields experienced from the end of the first quarter of 2019 to the end of the first quarter in 2020 points to a meaningful increase in yields. Since 1990, we have experienced 6 yield declines of at least 1.5% over 4 calendar quarters, as the chart shows. In all 6 cases, the 10-year Treasury yield was higher a year later by an average of 90 basis points, or 0.9%, as well as 6 quarters later by an average of 110 basis points, or 1.1%. So this is what's giving us some of the direction for where we see fixed income heading in 2021.
So, Bill, we often get this question from clients. Well, then why bonds at all, right? Well, here's why. Bonds hold up well during equity market declines, and while we believe the stock market will be strong, we know in regular trading years we're going to have pullbacks. Despite lower return expectations, high quality bond holdings may continue to play their role as portfolio diversifiers. During the 6 stretches in which the S&P 500 declined at least 10% between 2010 and 2020, Treasuries typically led, and the Bloomberg Barclays U.S. Aggregate Bond Index gained on average. You can see the returns for the S&P 500, the Ag, and the Treasuries broken out into this chart. there's an important lesson in the overall pattern. Even when positioning for a rising interest rate environment, exposure to core bonds, including treasuries, can help provide important ballast with stock declines. If rates do run higher because of strong economic growth, potential stock gains may be able to offset bond losses, and this is why we diversify.
Great, Byrke. And that concludes our 2021 LPL Market Outlook through LPL Research. We want to thank you for attending today's webinar, and we will be moving on to the Q&A shortly.
Thank you, Bill. Thank you, attendees.